Welcome to the Wealthwise show, where financial wisdom meets the road to prosperity. Get ready to embark on a journey to make wise financial decisions and unlock the secrets to building lasting wealth. I'm your host, the Wise Investor, and just as a disclaimer, I'll go get some compliance out the way. This podcast is intended for educational purposes only. It is not intended to be tailored personal advice, because I don't give personal advice on the internet. So keep that in mind as you continue to listen to this podcast. That is for educational purposes only. And if you hear a product, like a service or a company, anything like that, I'm not endorsing them unless they're sponsoring the show. Well, then it's an endorsement. So just keep that in mind as you get into today's episode of the Wealthwise show. Alrighty, guys. Another episode, another week. Let's get some compliance out of the way. Guys, this is for educational purposes only. This is not meant to be used as personal advice because I don't know you. So please do your own research. Understand that this is for educational purposes only. And if you need an advisor, Google is your best friend. Make sure they're licensed. And I don't give advice on the internet unless I don't actually at all. But if you're my client, this is not advice. Talk to me later if you need some advice. So without the way, I want to talk about, last week was a nice week about different things of investing. But I was thinking I wanted to talk about bonds. And I know I talked about bonds like maybe 3 or 4 times on this podcast. And that's because a lot of people just don't seem to understand what they are. And a lot of times they don't understand that bonds can be an essential part of your investment portfolio. So I've talked about bonds heavily. But making sure that bonds in your portfolio help strengthen the risk return profile through diversification. And what does that mean? What did you just say? So basically, bonds is going to produce income. That income can help offset any drawdown. Bonds can also have a drawdown, but if you own the actual bond, if you hold till maturity, you're going to get all your money back, plus keep the interest. So bonds are a good way to preserve a portion of your cash while producing income. That way, if let's say something that goes wrong with the market or whatever your other risk assets, your bonds is a nice way to keep your money safe. I always view it as a hedge almost. And yes, like I said, bonds do have risks. Like if you have corporate bonds, you do run a risk of not getting paid because it's technically a loan. But if you go with the U.S. Treasury bonds, they are pretty well known for their payments. They do pay less in interest because they're very, very good at giving their payments. But it's a nice little way, especially now in this time. Like, the Fed's are going to raise the rates 2 more times this year. So if I have a decent sized portfolio and I understand that, I'm going to capitalize on that while interest rates are at an all-time historic high. I want to say a historic high, but like higher than it's been in a very, very long time. So it's understanding that preserving a portion of your capital, because I know everyone wants to throw all their money into growth and tech stock and the indexes. That is great, but you're literally throwing all your money into one basket. Simple as that. Where's the diversification? So what are the different types of bonds? Like I said, corporate bonds, owning company bonds. Corporations issue debt so they can take on as loans so they can go make more money. And tech stocks are really known for this because it costs a lot to innovate. And so issuing debt is important for these companies. But the thing is, it is risky. Because like I explained in a few videos, bonds, especially their yields and all that stuff, is based on their credit worthiness. So just like us who have a FICO score, well, businesses have a score as well. You got Standards and Poor's or Moody's. Standard and Poor's is the S&P. They are, basically like the credit companies for corporations, and they issue them a rating. So depending on their rating, will very much depend on one, should you invest, because if they're not good at paying their bills, two, the interest rate. The lower the rating, the higher the interest rate, just like anyone else. And the higher the rating, the lower the interest rate, just like anyone else. Then you got sovereign bonds. Well, what is sovereign bonds? Issued by governments. You got high credit ratings typically, but relatively low yields. Why is it low yields? Because, like I said, if you have a high credit rating, you're going to pay a lower interest rate. Like, what if you had an 800 and you go get a car and they say, hey, man, your credit, you've been approved for a loan, but you're approved at 15% interest and you have an 800 credit score, you're going to be appalled. I'm like, what? No, get out of here. So that is why. Then you have municipal bonds, something that a lot of people don't talk about. But if you are in a certain tax bracket, if you have a lot of income, it can be used very well. Talk to your financial professionals to see how. But municipal bonds are essentially government bonds, local government bonds. So you got, if you live in a state, your state issue bonds, because they need money to help keep up the roads, and along with their taxes and things like that. They use that money for projects and things like that. So municipal bonds are great at, if you live in a certain area, to help the area out, and like I said, there are some advantages for municipal bonds that a lot of people who are new, I should say, to learning finances don't know about. Talk to your advisors about that. I'm not going to spoil that one. So you got, the different terms of a bond. You got maturity, you got secured and unsecured, you got liquidation preference, you have coupon, tax status, and callability. So maturity is pretty much the date that you get your money back. It's plain and simple. If you have a U.S. Treasury bond and they say, hey, you're going to get your money back 1 year from today, well, 1 year from today, expect to get your money back. So that's basically what maturity is. Secured and unsecured, kind of like anything, secured loans, unsecured loans. Secure loans are secure bonds, is backed by, collateral, and unsecured bonds are not backed by collateral. Very simple. Very simple premise here. Liquidation preference. What is that? Well, if a company, goes under, like if you have a corporate bond, the way assets are divided. So you have your senior debentures. Well, there's more words. Don't worry, guys. I will explain a lot more in future episodes. You're going to be with me forever. Maybe not. Let's hope so. But, so it depends on, who basically going to get something first. The order that if something happens to this company, the order that liquidation happens. Then you got coupon. What is the coupon? Well, that's going to be the face value or a percentage of the face value. So typically your treasuries are issued at what they call par, which is $1,000. So if it's 5%, the coupon is 5%, means that the interest rate is 5% of $1,000. Pretty much that it. And the reason why they call it coupon, because back in the day they used to have coupons that you can peel off and turn in and get the money. And then you got tax status. You got taxable and tax exempt bonds. Talk to your financial advisor. It has something to do with municipal bonds and federal bonds. Then you got callability. Now this is an important one. I'm going to take a little more time on this one because it's important to understand what callability is. So if you have a corporate bond and it says it's callable, basically what that means is that the company that issued the debt can call that debt back, meaning pay you early, and reissue that debt typically at a lower interest rate. Not reissue it back to you, but you can buy it again, but it'll be at a lower interest rate. So typically a lot of, well-known companies, a lot of high credit companies, they do that. They have what's called callable bonds because, you know, just like anyone else, you're going to want to refinance if interest rates go low. So this is just a way that, they can refinance essentially. So there are some risks with bonds, of course. It's, with mostly anything in life, there's risks associated with it. You got interest rate risk. What does that mean? Meaning if, like we are now, high interest rate environment and the federal government keeps going up, then you're looking at your bonds going lower. You might say, well, why were your bonds go lower? Because if, let's say I have a 5% bond. Give me 1 second. I'm going to take a swig of water. I have a 5% bond, right? And they go up 0.25%. Now the bond rates are 0.25%. Why would anyone buy my bond if I'm trying to sell it at par, which is $1,000, when they can just go and buy something at par and get more return? So what I would have to do if I want to get out of it quickly, I got to lower the price. I got to lower the price on it so I can get out of it. And so that's how bond prices move, because if you hold to maturity, you're going to get par. But sometimes stuff happens and I might need to sell early. And depending on the interest rates at the time, it can produce some risk. Then you got credit and default risk. Basically, like it sounds, they just can't pay. That can happen with a lot of corporate bonds and even some government bonds, not the U.S. government, but I'm talking about other governments. Because you can buy bonds in other country governments. But yeah, they might not can pay you. Simple as that. They can't pay you. Then you got prepayment risk, which is essentially, like I said, with the callable, meaning, hey, you at 5%, you rocking good, getting 5% every 6 months or wherever the terms are. And then, Jerome comes in and says, hey man, these rates are too high. Let's drop it down to 4%. Well, that company might be like, whoa, 4%? And I'm paying 5%? Let's refinance. So they gonna pay you back early and issue bonds at a lower rate. It is what it is. So those are pretty much how that works. Now, on my outline here, I have some formulas that I had to learn when I got my 65 that I don't have time to explain to y'all because this is a short podcast. It's basically like yield to maturity, nominal yield to call, and all that stuff. I ain't doing all that. Investopedia, Google's your best friend. If you want to learn all that stuff, just understand those are just different ways to calculate the values of bonds, but you really don't need to know all that if you don't have to. So that's pretty much it. I skipped a lot of stuff because it's really technical. But that's the juicy stuff that really most people who are not professionals need to know, to help them make wise decisions. So, that's going to be it, guys. Another short and sweet episode, I hope. Hope you guys are enjoying these. I know the episodes are a little shorter than normal. But you can't tell me what to do. So thank you guys for listening. Thanks for tuning in for another great episode. I feel good about this episode, so it's definitely gonna come out. Some episodes don't come out. And I really appreciate all the support and all the love I've been getting on these episodes on the different platforms. And keep listening to them, share them, like them, subscribe them, do whatever you can to help support. I appreciate it. Like I said, if you guys, I'm not your financial advisor, but if you don't want a financial advisor or you don't have enough money for a financial advisor, or things like that, Investopedia they're not sponsoring me, and I'm not affiliated with them, but I do really like what they do, because they got almost everything you can think of in the definitions and stuff. So Investopedia is nice. YouTube, Google's. Do your research, guys. Please don't be a sheep. And let me take that back. Be a sheep of God. But like I was saying, don't just follow, whatever someone says, especially on YouTube, especially if you don't know them. Actually, I might say even if you know them, don't just follow what they say. Do your own research, guys. It's important because you are working hard for this money. You wake up every day, you go out every day, you go get that money, and you come home and you bring that money into your house. Don't just let people do and tell you what you should do with your money and tell you what to do with your money. You should decide that for yourselves because it's your money. They don't tell you how to go make it, but they definitely will tell you how they gonna take it. Hey, that's good. I'm gonna write that down. So yeah, guys, be smart, be wise, and until next time, guys, stay Wealthwise. Investment advisory and financial planning services offered through Simplicity Wealth and SEC Registered Investment Advisor. Sub-advisory services are provided by Simplicity Solutions, LLC, a registered investment advisor. Any insurance, consulting, and education services offered through the Wealthwise Show. The Wealthwise Show is not affiliated with Simplicity Wealth and Simplicity Solutions.